Industries Limited Q4 and FY26 earnings conference call, hosted by Kotak Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on a touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jay Doshi from Kotak Securities. Thank you, and over to you, sir.
Thanks, Swapnali. Good afternoon, everyone. On behalf of Kotak Institutional Equities, I welcome you all to Q4 FY26 earnings call of Pidilite. We have with us Mr. Sudhanshu Vats, Managing Director, Mr. Kavinder Singh, Joint Managing Director, Mr. Sandeep Batra, Executive Director Finance and CFO, Mr. Bhavesh Joshi, Senior VP Domestic Accounts and Taxation. I'll now hand over the call to Mr. Batra for opening remarks. Over to you, sir.
Thank you, Jay, and good afternoon, everybody on the call. I take great pleasure in taking you through the Q4 and FY26 results, which were approved by our board at its meeting yesterday. A quick summary of the performance for the quarter. In the current quarter, our standalone revenue at 3,272 crores grew by 15.3% in value terms and was underpinned by an underlying volume growth of 15.3%. This compares to underlying volume growth of 9.8% that we had delivered till December and 9.3% UVG that we delivered in FY25. Both our consumer and bazaar and B2B businesses recorded strong UVG. Consumer and bazaar was 15.4% and B2B was 14.8%. I think the only line of business that saw some disruption was in exports, both for consumer, bazaar and B2B, where in the month of March, because of this conflict in Gulf, in West Asia, supply chains were disrupted and our export revenues got impacted. However, till February, the performance had been strong. Our gross margins also improved versus Q4 last year by 100 basis points and were kind of in line with the immediately preceding quarter. Our control on costs, where total costs, despite little bit of extra charge on account of wage code, all our costs below margin increased by only 9.2% compared to a sales growth of 15.3%. And you can see this operating leverage flowing back to the EBITDA. And EBITDA margin at 23.4% expanded by 280 bips versus same period last year. And for the quarter, EBITDA grew by 31.1%. PAT growth was slightly slower, largely because of timing differences regarding dividends that we get from our subsidiaries. In last year, in Q4, we had received some dividend, which in this current year either would have come in the previous quarter or will come subsequently. As well as there was a little bit of impact on our treasury income owing to rising bond yields, which caused some mark-to-market impact. However, the YTMs remain strong on all our investments. The board also approved a final dividend of 11.5 per share on an expanded share capital. You may note that last year we had announced a 1-for-1 bonus. This dividend will be paid subject to approval by the shareholders at the AGM and is in addition to the special dividend that we had given of rupees 5 a share. So this, including the special dividend, the payout ratio will be around 70%. If I look at how our subsidiaries performed, the international subsidiaries in the quarter grew by 8% and domestic subsidiaries grew 5.3%. In domestic subsidiaries, The waterproofing business, which is under the name of Nina, had some headwinds because of environmental challenges in getting work front where they could do waterproofing. So the Nina waterproofing business would have declined by 16%, but the rest of the businesses, which are largely consumer and bazaar, recorded very strong growth and very strong profitability. Consequently, our total consolidated revenue grew by 14.1%. EBITDA margin expanded by 310 bips. All of it flows down to PAT, which grew by 36.6%. For the full year, again, consolidated revenue at 14,553 crores was up by 11.1%, and EBITDA margin expanded by 120 bips over all of FY25. And PAT grew by 18%, 17.9%. The performance on cash, including working capital, continues to remain strong, and we continue to invest behind capacity as well as other initiatives. So our capex in the year also was higher than what we had spent in the previous year. With this, I open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and then one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants, you are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all, you may press star and one to ask a question. We will take the first question from the line of Abneesh Roy from Nuvama Institutional Equities. Please go ahead.
Thank you, and congrats on very strong numbers. My first question is on the share swap that you have done with JSW One. Why transfer your BuildNext platform, BuildNext construction solution? And is this a financial investment in JSW One, given there is a plan for an IPO? And you do compete in paints, I think. So could there be some kind of a strategic tie-up in paints also? Is that possible?
So, Abhish, I think as you asked, I think the reason is that we found strategic synergies in doing this transaction. I think BuildNext basically has a good home in JSW One. And yes, you are right, post the transaction, we will be shareholders of JSW One as well. As far as the other synergies are concerned, we will explore them as we go along. I think, that's where we are, Abneesh, on this one.
Well, that's a very significant statement. You'll explore. So you do compete in paints. In fact, you have bidded against each other in paints to acquire Adzo. So yeah, that option is there, right? In terms of exploring.
Yeah, as these marketplaces come up, Abneesh, I think the spirit in which you should take it is that as these marketplaces come up, and I think JSW One and there's also Birla Pivot and all that, I think these will go well beyond their own products for them to be successful marketplaces. And therefore, and there is always, inquiry on that sort of other products, including ours. So what our point of view is that we will keep evaluating it in the manner of speaking and see when it is right for us to be on one or many of these marketplaces.
And on my question whether this is a financial investment, historically I've seen that Pidilite likes to have stake in these kind of distribution / new consumer platforms to get access to data, to get some preferential orders, etc. So is this a financial investment or is this more strategic?
So see, it is at this moment through the transfer of BuildNext a financial investment. We own shares there in JSW One. Therefore, I think the point is because in these kind of places, I think that concept of, so what you rightly speak about is correct, that when we look at very new startups or we always have some kind of we want to take a deeper look at them. We have some investment in these cases. But in this one, that philosophy applied to Build Next, where we had indeed invested. You are absolutely right. Now, having seen that for some time, we think JSW1 is the right home for Build Next to take Build Next further as we go forward. And I think in that context, with this transaction, we will become a small shareholder with JSW1.
I mean, at least our shareholding in JSW will be quite insignificant. So Build Next was strategic for us, and Build Next, and for I think JSW was for JSW1 also Build Next was strategic, and we felt that the business is best served with an owner like JSW who can provide it scale and profitability. So we were very happy to swap our shareholding there. Our shareholding will be insignificant in JSW1.
Thank you. My second question is on demand side. So we have seen very good recovery across most of the FMCG names. And Sudhanshu, you have worked obviously in FMCG and now in Pidilite. So are you seeing a genuine demand recovery? Because in your case, there was obviously no GST direct benefit of any cut. Plus, biscuit company today in a call said that some of their Oman manufacturing has been transferred to India. So any one-off in this quarter, 15% volume growth, extremely impressive. But that's way ahead of what you have delivered in the past few quarters, 9 to 11% range. So is there anything new, anything one-off, any Oman business, Middle East business has been transferred to India?
No, first of all, there are no one-offs. I think I can ask Sandeep to further elaborate, but absolutely no one-offs. I think on the demand recovery, I've been saying this, and I said this in the morning in media interactions also, Abneesh. I definitely believe that in the quarter that's gone by, quarter one calendar and quarter four financial, I think there has been a buoyancy in urban demand, and we've seen it, and you've seen it across the sector, across other companies in FMCG sector. I think some of it is flowing through, in my opinion, from the actions taken in the past, basically the GST 2.0, and also in our case, in discretionary categories, I think the budget announcements which happened in previous year budgets by Honorable Finance Minister, and that basically where she gave in arguably about 100,000 crores in the hands of tax-paying Indians. I think so there is that you are seeing in discretionary as well. So coupled with both, and while we have no direct benefit on GST as a company, you are absolutely right. But I think GST reduction coupled with some other environment gave a fillip to discretionary and sectors. And we are a combination of both classic consumer good and a little bit of discretionary. I think that has helped, Abneesh. So these are all these numbers. And before March disruption and the West Asia conflict, we saw some very good numbers in February as well, and both in January and February. As a matter of fact, we had a very, very good February. I can share that with you now that the quarter. So I think so therefore, it is irrespective of any of these things. I think there has been a buoyancy. As I travel across the country, both large cities and small towns, I continue to see a buoyancy in demand, and I think we have to wait and watch as to how long it continues, and if at all any of the West Asia conflict has would be a headwind to it as we go forward.
One last follow-up and I'll end there. So if the entire company has seen 15% volume growth, will it be fair to say that even the core parts, so overall Fevicol, including the recent innovations past few years, that also would have grown high single to double digit, early double digit?
Absolutely. As a matter of fact, I think you've not been following. I've been saying this. So if you look at, if I was to I think maybe this question will come by many people. Let me just spend a minute on sort of talking about the quarter that went by, or the quarter we are talking about, quarter four. So I think we've delivered this 15.4% in CNB and overall 15.3%. I think if I was to look at it, our growth categories and growth brands, first of all, continued the momentum, but delivered at the higher end of the growth band we talk about. So that is Roff, Dr. Fixit, both of them delivered really well, Abneesh. But coupled with that, and we basically, our core businesses delivered well as well, especially Concall, delivered a double-digit growth in the quarter that went by. So you are absolutely right. And it's a combination of basically the portfolio in general firing quite uniformly in this case. And Sandeep was jokingly saying that all our batsmen played quite well. So I think that's the thing which has happened. So therefore, I think that is the case. But having said that, Avnish, if you look at it, we've been talking about this for some time. And I think as a company, we would like to continue to raise the growth as we go forward. And what I'm happy about is to talk about the FY26 growth, UVG growth numbers, which is about 11.3. That has come in at about 120 bits higher than the previous year. So our desire and our planning is to therefore keep raising this systematically. And I think as we go forward, we will see that. The other thing which you see in EBITDA margins, which Sandeep talked about, which is basically we delivered about a 300 bits expansion in EBITDA margins. See, 100 of that is coming through gross margin, which is largely material benefit, which is flown through. But the balance is also coming through operating leverage. And that's an interesting point again. So the moment we lift our growth, I think our operating leverage kicks in better and sharper. So I think, so that's the piece. So that in some ways is the story of the quarter, and I think maybe relevant to some of the other questions which come in later as well.
Thank you. That's all from my side. Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. We will take the next question from the line of Sonali Salgaonkar from Jefferies. Please go ahead.
So thank you for the opportunity and congratulations on a great set of numbers. I have 3 questions. Firstly, on the Middle East supply chain disruption. As we are standing in May, what is the extent of supply chain disruption, mainly in VAM? We understand that there was a significant jump in your operating margin in Q4, probably because you had the earlier lower cost inventory. But right now, the data suggests that VAM prices have spiked and surged. So how do we foresee to navigate this situation?
Sorry to interrupt in between, Sonali. Could you please repeat your question and use your handset mode?
Yes. Is this better?
Yeah, slightly better.
Yes. Thank you very much. Sorry for this. So my first question is regarding the Middle East disruption. The VAM prices have surged. So right now, it has almost surged by 70% since the start of the conflict. So how do we foresee to navigate the situation right now?
Yeah. Sonali, so therefore I think so when you look at West Asia conflict, as a management team and as a company, we have 3 key priorities. I think our first and foremost priority is the safety of our people there. We have an operation in Dubai. So I'm very happy to report that we are doing well on that count. So I think that's our top priority. Our second and a very important priority is supply security, and perhaps that's what your question is about. So I think what we've done is to sort of look at all our raw material and therefore map out everything which we sort of consume and see how each one of them gets affected. Fortunately for us, we started discussing a possible Iran conflict almost a month before actually the conflict happened. So therefore, we've basically been able to map some of these things out. We've been constantly looking at alternate supplies, if possible, wherever possible. So I think as a company, and in this what we are doing is, we basically take this by, day by day, every day, but more importantly, weekly, monthly, quarterly. And I'm again happy to report that in the quarter that we are in, we've secured ourselves on almost everything. There are a few surprises that keep coming up, but we are finding very innovative solutions. We are extensively in touch with people where we can get the thing. So supply security is largely taken care of. And lastly, to the point of inflation, which is the third point, I think inflation is real. On our weighted average raw material basket, inflation is anywhere between 40 to 50%. And therefore, we are looking at that. Here, our strategy is very clear. Our strategy is that we will first pass on the absolute increase in our raw material prices in rupee terms in a calibrated fashion because our focus will remain growth and disciplined demand generation in the market. So I think we want to sort of continue to drive growth and continue to sort of build demand for the products we have. And in this context, we've taken one price increase in early to mid-April, and we have taken another price increase in early May. So I think therefore we are doing this and we will keep watching this situation. I think there are two possible scenarios. One is that West Asia perhaps has a pause or a solution in the month of May itself, more likely a pause, and therefore, if you come back to somewhat normalcy as you sort of, so that is likely scenario in the month of May. We are hopeful on that scenario, to be honest with you. The other scenario is that this conflict continues for longer. If the conflict, in the first scenario, we feel that the demand is likely to remain buoyant in a country like India, and the inflation will be manageable as we go forward, although there will be inflation in the year. In the second scenario, we'll cross the bridge when we come to it, but we are doing a little bit of scenario planning from a supply security point of view, and we remain quite confident of our disciplined execution in this space.
Understood, sir. So may I ask, what is the quantum of the two price hikes that you have taken in April and May?
So the price hikes are different by category, and you will get that information from the market as well. But to just give you so there are certain categories where there is not that much increase in the raw material prices. A few categories, but they are there as well. There the price increase is very muted. But there is, on the other extent, the VAM pricing, which I'm sure you've already heard from Sandeep. I think it's already hovering at around $1,800. In that case, which is Concall as a brand, and that our Concall division, there we've taken about a 5% increase in April, and we've followed it up with another 7-8%, 7 to 9. Again, varies from product category, product to product within the Concall division as well in early May. So I would suffice to say about 12 to 15% price increase.
Understood.
Yeah, and also, Sonali, I think the raw material situation is changing every day. So there was a period where costs were only going up, but if I look at last week, 10 days, given that oil also has corrected from 110 to below $100, we've also seen some reversal of some of the increases that we had factored in. So it's a very dynamic situation, something that we are watching very, very closely on a weekly basis. And suffice to say that for now, significant amount of the cost increase in rupees terms has been factored in. It's not that we have run down all our low-cost inventory in March. We have a very healthy inventory, and particularly in some critical raw materials like VAM, we carry much higher than normal covers. So we have some protection against inventory even going into the first quarter, and it's something in the situation that we continue to watch very, very closely.
Well noted, sir. So my second question is regarding ROF, which is especially has the application towards tiles. Now, I do cover other building material sectors like tiles as well, which is why I would also be aware that March, April as a month, as these 2 months, there was severe shortage of gas supply, especially for the Morbi cluster, where many of the organized tile players also had their plants. So the production and the capacity utilization have been severely impacted. It's interesting to understand that ROF as a category has grown very well for us throughout Q4. So would you help us understand exactly, where the end demand was for ROF, which categories, which regions, so that we can help bridge this gap?
Yeah, so first of all, let me comment, and I think, as I was saying earlier also, I keep traveling all over the country. So I think that so your point that Morbi got affected is absolutely correct. As a matter of fact, most industries that are gas-powered did get affected in a reasonably significant way. That's correct, absolutely correct. However, I want to make a small correction that when it comes to tiles, the stock in the pipeline first and foremost with the dealer and a little bit otherwise as well, is very, very high. It's considerably higher than most other categories. So my understanding is, at least for the formal, for the players who are the formalized sector, those players, the stock cover is quite high. It runs, so therefore the impact of that, immediate impact of that on demand is not likely to be seen, and will be an impact only if it's a protracted West Asia conflict with a severe gas issue even then. So therefore, the fact that gas-powered industries have got affected, absolutely correct. They were operating at a very low capacity utilization in this period, absolutely correct. But is there stock available in the market? Absolutely yes. Is construction going on and therefore tiles getting fixed and therefore rough getting used? Absolutely yes. So I think that's how I would say, at least as of now. Again, all these things will change. Supposing it's a protracted and a severe West Asia conflict, which is the scenario. So the probability of that at this moment is a little low in our judgment, or in everyone's judgment.
Understood, sir. Very clear. And last question from my end: any update on paints?
The last question is update on
paints. Yes.
Yeah. So paints, I think, see, what is happening on paints is two, three things. I think one, as we look at our business, we are seeing better or good traction, if I can use the word, in rural India, which is rural and very, very small town. So that part of the business is doing well. We were there in the 5 southern states, South TK, as you guys know, but we've gone into West Bengal, gone into Bihar. So our rural piece is doing okay. I think when we start looking at slightly bigger towns, what we call internally small town India, I think that's where what is the uniqueness which Pidilite has to bring in, what is the tweak needed in the business model, what will be our USP as Pidilite to give us that right to win, is something still work in progress. And I think once we are able to solve for that is when you will see a full-scale expansion. Other than that, we are sort of at it. There is growth, as I told you, good growth in rural, I can tell you, and I think so. We will keep working towards finding that unique Pidilite signature, and therefore our right to win.
Understood, sir. Thank you. Very clear, and all the best to the team.
Thank you.
Thank you. We will take the next question from the line of Sid Gandhi from IIFL Capital. Please go ahead.
Hi, this is Percy Panthaki here. Sir, continuing on the cost inflation part, could you help us with understanding at the current spot prices for your product portfolio basket, what is the overall weighted average inflation in the COGS?
So I spoke about it in the sometime back, Percy. I think, first of all, good to hear from you. But I think, Percy, it's in the range of 40 to 50% as our weighted average raw material basket. So I think that's where it is. That is at the current replacement price. But as Sandeep very rightly pointed out, just in the previous question, I think, if I'm not mistaken, the situation is rather dynamic, Percy. So I think the point is, if we were to look at the peak, that number is, this is the number. But I think we are seeing a few raw materials coming off the peak. So therefore, that's why I tell you the approach which I highlighted, and maybe maybe I'll repeat it, and then the risk of repetition, for everyone, is that our approach is that we are looking at this replacement margin, so to say, at the current costs, and saying that first and foremost, how do we transfer these costs in a calibrated fashion into the market, calibrated and sort of say over staggered a little bit. So therefore, and we've done 2 rounds, one in mid-April and one in early May, and then we'll keep watching the situation as we go forward to take any further action, because our topmost priority is to continue basically our focus on growth and continue to do all the demand generation activities which we need to do. And as a matter of fact, you may have seen that we have continued with our big campaign on Concall in this environment. I think that's of course above the line, but we are doing a lot of the stuff below the line as well, which is our field marketing activities. So our focus is on continuing to remain steadfast on delivering a double-digit underlying volume growth and do demand generation appropriately as we go forward.
Just a clarification, this 40 to 50% was for the COGS of Fevicol or the company as a whole?
Weighted average company, my dear.
Okay, got it. Second question is, in the past, based on your experience for your product portfolio, what is the price elasticity of demand? So what I'm trying to say is that, let's say in an environment of close to zero pricing growth last year, you did a volume of, let's say, 10%. Now, supposing this year also, if the inflation was flat and the growth was zero, assuming demand being similar, like that's the base case, that zero pricing and 10 volume. But if, let's say, the pricing goes from 0 to, let's say, a 10 or a 15, the volume which is at 10, that comes down to how much? So is it 50% of the price increase, which is a volume backlash? Is it a 20%? Is it a 80%? What is your experience and what is your expectation given the current macro situation?
The current macro situation, first of all, is rather unique. It's different from anything which has happened in the past, including COVID. Because I was recently in the market, there is 30% increase in pipe. There is about 15% increase in paints. We are around similar zone. And as of now, cement has not, declared, but there would be increase in cement as we go forward. There will be increase in fuel prices as we go forward, which have not yet been declared. So the cumulative impact of a lot of this on demand is something which needs to be studied, needs to be understood. And as I was saying, Percy, in the previous question, see, my request to you all is that there are basically two scenarios. The scenario one, which is that West Asia conflict is contained or at least partly resolved in the month of May. And there is a good chance of that, to be honest with you. That's our understanding. Scenario two is West Asia conflict continues for much longer. And it is longer and it is tougher, or whatever word I can use. So basically, in the case of scenario one, I think we are going into the hypothesis that the demand buoyancy which India saw in the last quarter of FY26 will more or less sustain. And therefore, in that, if we then manage the inflation better as we go forward, and therefore inflation will also hopefully come down in the second half of the year, although you'll have to manage inflation through this year. I think in the combination of these two, you've got to do from a demand generation point of view and growth, treat it as business as usual. That is our going in position. Now, what happens if the scenario 2 plays out? I think we are currently focused on supply security in that scenario, and we will talk about it if that scenario plays out.
So as of now, should we just assume that whatever pricing you take is completely incremental to the top line and there is no volume backlash that you expect?
This I leave to you. I will not be able to give you your formula for the thing. But so some of it, to be honest with you, with this kind of inflation, Percy, to be honest with, and again now on a more serious note, if you were to look at FY27, with the kind of inflation across categories, across businesses, will there be some demand compression? What will be the quantity of demand compression and when will it come is difficult to predict at the moment. I can tell you for the quarter, I can tell you for the period which we have seen. So what I have seen up to now, and we've been traveling quite extensively because of this dynamism in the situation, I can tell you as of now it seems rather intact. But with this kind of inflation, once it settles in fully, should there be any kind of demand contraction, how much will it be and when will it be, is something to be watched out for. So to be fair to say that the full year, should you assume that it will be the same? My answer is no. But should we continue to see the momentum in the quarter one? My answer is perhaps yes. So I think, here now, as we go forward, I think we've got to look at month, maybe ideally week, month, and a quarter, and then keep revising it as you go forward. So a week, month, quarter, again a week, month, quarter, and that's the way you've got to decide here. Here you cannot talk of 2 years full of this year because it's very, very dynamic, my friend.
Got it. Last question on margins. Assuming that we settle, let's say, at 85 to 90 kind of crude level for the rest of the year, what kind of margin can we expect? Do we expect it at the lower end of your band, which you earlier said that you want to maintain a 20 to 24% kind of band? So do we expect it closer to a 20% this year if the crude sort of remains at a 85-90 level?
So it will depend on the crude is one marker, but I think as Sandeep was saying, I think some of the other raw materials are linked to crude, but not entirely. So it depends on what is the inflation, because some of the inflation could be much higher than crude as well, or in many cases it could be lower. So it depends on that. As far as we are concerned at this moment, I would say we've guided a corridor of 20 to 24%. We stay committed to that guidance. And last year, of course, with benign input costs, we delivered at the higher end of the guidance. This year, with the raw material inflation, it'll be different, but we stay committed to that kind of number. So I think you are right. So it'll depend as we go forward. It's very difficult to say for the year, and I think these things are only meaningful for the year, not for a quarter or anything.
Understood. Thank you very much, sir. That's all from me. All the best.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. We will take the next question from the line of Navin Trivedi from Motilal Oswal Financial Services. Please go ahead.
Yeah, hi. Good evening, everyone. My first question is on in the consumer and bazaar. Can you give us a bit more understanding about this sharp 15% volume growth which we had witnessed in the fourth quarter? Was there any trade pre-buying benefits also built up in the fourth quarter? And how should we see the trend going ahead?
What benefits? I couldn't get that. What did you say?
Some trade pre-buying benefits in anticipation of price hike which we would have been seeing.
Trade stock. Trade stock. Okay. I didn't thought of, yeah. No. So as I was saying in response to an earlier question, I think first of all, we have been seeing reasonable buoyancy in demand. And I can share with you that we had a very robust February. And I can also share with you that at Pidilite, we have continued with our philosophy of not loading in any form in the month of March. So we always have, and which is a well-tested old Pidilite practice, which is to sort of, towards the second half of March, contrary to what many other companies may do, we actually sort of, but we don't, not only not load, we go a little slow. And then we start fast in April. That is the pattern we follow, and that's been what we've been doing. This year has been very similar, I can tell you that. I think, is it 0.5% here and there? Some of that could have happened somewhere. You can't vouch for every 100%, but the point is that we followed this philosophy, and the same has been practiced as we went into March, and the same has also with data been seen with our start to April. So I think, therefore, to answer your question, no, if I could say so. This is a buoyancy. And as we were saying earlier, see, the thing is that we've seen this buoyancy, and therefore what has happened is that our growth categories have delivered to very well on growth. So that momentum has continued, has only accelerated. And some of our growth brands have delivered at the higher end of our growth brands guidance. And our core categories have also done well, including our big brand, which is delivered in double digit.
So is it fair to say that
and behind all of this, there are things like innovation, things like field marketing, many of those. So I don't get into that detail. So all that work is happening. We've been continuously doing some of this, and we've been lifting it up. between you and me, I think, I and Sandeep have been talking about lifting our growth for some time now. And I think what I want to do share is that for the year, I think that's the way to look at it. In the year, we managed to lift our underlying volume growth, which is most important. Forget price here, there, price there. Underlying volume growth by about 100 plus BPS. And I think that is the journey we would like to stay steadfast on.
Sure. Thank you so much. And any color about the market share point of view also? So although Consumer and Bazaar is a very diversified portfolio, but any core categories where you can give us some sense about how has been our market share during this period, or how has been the kind of industry growth rate during this time, especially the core categories, if you can give us some color.
Yeah, so I think as I said, the same point, there's been a buoyancy in the market. So the market would have grown a bit better. But I think our performance is a combination of three things. I think a natural buoyancy, particularly a little bit more buoyancy in urban India. And therefore for us, while our rural growths have come in ahead, actually again, like year on year, even in this year and this quarter, but our urban growth has picked up. So I think therefore there is buoyancy. The second piece which is there is that all the work which we do, we've intensified in several areas our work on demand generation and field marketing, and I think that's bearing some fruit, particularly in construction chemicals and Dr. Fix-It. And lastly, I think there is some market share gain as well, because the kind of growth we are seeing, we are clearly growing ahead of the market in some of our growth categories and maybe in some of our core categories.
Sure. And in terms of the price hike, you mentioned about you will take very calibrated approach this time, despite there's been sharp headline inflation. How are you seeing the competition side? Are they also following similar approach, or you see that there can be an opportunity, given you may have a cost efficiency, and you also, like Sandeep was mentioning about, you also have inventory in your hand. So do you think that these are the times when you can further look for a market share gain?
No, I think the way we are looking at it, first of all, I think factually the competition has done similar kind of price increases. A few of them actually did it in March as well, some of them. But I think so therefore price increase has been commensurate. It's not or similar, comparable. I think the point is that we would like to continue to do what is right to gain share, and I think we wouldn't do anything just tactical, to be honest with you. And as far as we are concerned, to Sandeep's point as well, see, we are initially passing on the increase in raw material cost in absolute rupee terms. So therefore, some of the cushion which we have comes in handy in sort of managing the margin also as we go forward.
Sure. Just last one, bookkeeping. The employee expenses are only 3% in the standalone this quarter. Despite like this year, we have been kind of quite double-digit growth, and even if I look at the annualized number, it is kind of 8% up. How should we look at this expense going ahead, and any one-off in this quarter?
Yeah, there was a little bit of one-off. So I think first of all, I think the right way to look at manpower cost is to take the full year manpower cost, and from that you strip out all the impact of this wage code. That I think will give you the comparable full year manpower cost number, and that for your projections you could divide it by 4, and that's your base for next year. Specifically in this quarter, and compared to the base quarter, which was fourth quarter of last year. So what we had done was, in the fourth quarter of last year, we had recognized a provision of about 17-18 crores towards a discretionary benefit to be given to employees. Because of the new wage code, we felt that there was no need to continue with that discretionary benefit, given that everybody's gratuity benefits will get elevated under the new wage code. So that discretionary benefit we wrote back in the fourth quarter. Both amounts are if I round off, around 20 crores. So for sake of comparison, you subtract 20 crores from Q4 last year, add 20 crores to Q4 this year, and you will get about 11.5% increase in wage costs, which is pretty much in line with which would be the right number. So take the full year number, take out the one-off because of wage code, and that becomes your base for FY26-27. And specifically for Q4, I have addressed your housekeeping question. The actual comparable growth is about 11.5%.
Perfect. Thank you so much, and all the best.
Thank you.
Thank you.
Thank you. The next question is from the line of Rajeshwari from iThought PMS. Please go ahead.
Thanks for the opportunity and congratulations for the great UVG recorded. I have three questions. So the first is on the manufacturing capex. I understand that the growth in finance categories would need more investment, but in core categories, can we say that we have invested ahead of demand, or it is still needs continuous expansion?
Sorry to interrupt in between, Rajeshwari. Can you please repeat your question and use handset mode?
Yeah, sure. Is it better now?
Yes, it's better.
Yeah. So I have three questions. First is on the manufacturing capex. So I understand the growth in finance categories would need more investment in terms of manufacturing, but in core categories, can we show that we have invested ahead of demand, or it still needs continuous expansion? And also, I would like to know the level of automation that we have done in manufacturing.
Yeah. So first question, I think we talked about it in the past also. Our capex tends to be actually 3 to 5% of our revenue turnover. I think Sandeep also alluded to it in his opening commentary. Yeah. I think so. Therefore, and last year we've come in at about the median of that number or an average of that number. So I think that's the thing. And as far as our capex philosophy is concerned, there are three buckets in which we do capex. One is classic growth capex, in order to sort of anticipate our growth in different growth categories and in general as growth, and see how we are placed as capacity. Do we have the right capacity, and therefore there is capex to augment and be ready for the growth. The second capex which we do incur and is around basically automation, consolidation, and major renovation of some of our existing core categories, especially premium white glue. So I think that's one area where, as we speak in this quarter one of FY27, we would be commissioning a large plant in West India for our premium white glue and Concall. I think so that's an area which we keep doing from time to time. And third is for newer categories or newer areas we get into. So those are the three buckets. We will continue to invest in all three buckets appropriately. But suffice to say, the band is 3 to 5%, and I think we'll remain in that band. But if you want to
No, I think you've covered it. So capex is something that, as I said, our capacity planning is something that we do very, very rigorously, because the last thing we want is not being able to put material on the shelf because we run out of capacity. Obviously, the growth businesses will require more capex because they will run out of capacity faster. But even in core, we would do capex not only to augment capacity but also to automate and to make the whole manufacturing process efficient. Last year, we would have spent close to 570 crores on capex compared to 430 in the prior year.
Yeah, that helps. And my second question is that we have around 6 segments, right? 3 in consumer and bazaar and 3 in B2B. So how many of these 6 segments we have export exposure? Like the B2B pigments and preparations we are already exporting, but I want to understand about the rest of the segments and the geographical coverage.
Yeah, so our major export exposure is in pigments, as you rightly pointed out, Rajeshwari. Although having said that, we do export our finished goods to many countries, but that export basically need not follow the West Asia route all the time. There is some export to West Asia directly. So therefore, our direct exposure on exports is pigments, and in finished goods there is West Asia export, but then there are export to other places which are perhaps independent of this conflict. So therefore, overall, suffice to say that our exposure to exports is small as a company, as Pidilite, and therefore exports not coming through will not dent the overall performance of our company in any significant measure. If exports come through, that will be the icing of the cake.
Yeah, thank you. And then my last question is that I would like to know how much percentage of our raw material basket constitutes VAM. To understand the impact of crude volatility in our margins better.
So if you look at last year, it would be less than 10% of our, and I'm expressly calling out that if you look at FY25-26, VAM would be under 10% of our raw material consumption for the company. This year it could be a different story, but last year was less than 10%.
Yeah, that is. Thank you. That's all from my side.
Thank you. We will take the next question from the line of Jay Doshi from Kotak Securities. Please go ahead.
Yeah. Hi, thanks for the opportunity. See, for the past 11 quarters, you were consistently delivering 8-10% UVG, which accelerated to 15% in 4Q. So if one assumes that West Asia situation, probably stabilizes and raw material prices normalize in the next 2-3 months, should we expect FY27 UVG to be higher than FY26, say somewhere between 11 to 15%?
So Jay, I think this is to answer your question, this is a stated position. I think if you look at, of course, you've talked about last 8-10 quarters and then a blip in this quarter. That is also right, and that's one way to look at it. The way I am looking at it is a bit more, if you look at year on year, I think so. Therefore, we've been expanded by about 120 bips in FY26 in terms of UVG. So therefore, I think this about 100 odd bips expansion as we go forward is something we are planning for and we would like to deliver.
I think if I may add, Jay, I think, this question would have been asked for the last 2 years that your margins are expanding, input costs are benign, so what are you doing? And our response has always been that our first endeavor will be to reinvest all the headroom that we have in margin behind getting faster growth, because there is no substitute for growth, and I think if you see the result over the last 7 or 8 quarters, each quarter last year our UVG was more than 9%, and for the year we were nearly 200 bips higher than what we declared in FY25. So the endeavor from our side is to drive investments so that we can get faster growth. So that as an intent has not changed. It remains. We saw results all of last year, and we saw very healthy results in the last quarter. So that remains our endeavor. What will be the outcome? I think given the situation that we are in, it will be very difficult to hazard as a guess as to what will happen in this year. It's not a normal year. If it was a normal year, maybe yes, what you are saying would have been something that we could have agreed to. But this year is very unique and special. So no, I don't think we will hazard a guess as to what will be the UVG for this year. It's too early to say.
Understood. One bookkeeping question. So UVG is basically volume and mix, right? Now, if ROF is growing much faster than the company, and because it's a low value product, does it have is your tonnage growth even growing faster than UVG?
Absolutely.
We have talked about it many times.
Absolutely.
So what you call total volume growth is in order of magnitude different from our UVG. And that's a great question you've asked, Jay. Most people treat our UVG as volume growth. This is not volume growth. This is turnover growth at constant price, and our total volume growth is order of magnitude different. Order of magnitude.
It will be in multiples of that.
Yeah, it is in multiples. Absolutely.
Understood. A couple of more questions. One is, are you seeing unorganized player sort of struggle a little bit because of supply chain disruptions hurting them more than, a large organization like yours? And if so, then have you started seeing some market share gains in some categories where, your market share are still sort of, not as high as, let's say, 80-90% that you may have in Fevicol?
So see, there are market share gains in tile adhesive, but that does not have that much of a unorganized play. The top 4-5 players pretty much account for 80 to 90%. I think your point is generally correct, Jay, which is that basically the unorganized sector struggles a little bit in this kind of volatility, without doubt, and basically compared to more organized players and more. I think very early at this moment to say to comment on this, but we are ready to we stay focused on securing supplies, making sure that we have goods available and servicing the demand. So therefore, to that extent, we are very well equipped, and if some of this gives us some additional gains in the market, then so be it. I think that's the piece which is there. But a lot of it is it's slightly early, I think, in my opinion.
And I just want to correct you, Jay. We don't have 80-90% share in Fevicol. I don't want to go that on record. I'll correct it.
Okay, understand.
Yeah,
Maybe we'll ask you offline because you always. One final one. I think FY26 was a year where there was acceleration in waterproofing, and you had called out a couple of quarters back. 3-4 years prior to that, waterproofing was not growing as fast as what perhaps we would have liked. Does that momentum continue? And in that case, why is it that Nina Percept is still sort of having volatility from quarter to quarter, not being that great?
No, so I think the first question is absolutely, the first part of your question is affirmative, that indeed we have seen our waterproofing business get back to the kind of levels that a growth category should grow at, and that growth rates have improved every quarter. I think the issue with Nina is not about lack of orders. We have a very, very healthy order book. I think what happens in winter period, particularly end of Q3, beginning of Q4, is that because of these pollution restrictions, a lot of construction sites don't get permission to do work. So you may not get work front availability. So in cities like Delhi, Bombay, Hyderabad, the local authorities will impose restrictions. You are aware of this grab 1, grab 2, grab 3 that happens in Delhi. So a lot of activity gets curtailed, and that construction is one activity that gets impacted. It's not waterproofing that gets impacted, but overall, if that site is not allowed to do any work, they can't do waterproofing also. Not that, our processes are not creating dust, pollution or anything of that sort. But the overall site work comes to a bit of a halt.
Yeah, that's a great point, Sandeep. And just to build on it, Jay, I think, so retail waterproofing, and therefore to Sandeep's point, and therefore you are seeing very good growth in waterproofing. So retail waterproofing and smaller jobs which are done at homes and all that continue, but all these construction jobs which Sandeep referred to, which is where Nina steps in. Nina steps in for more specific, apply and supply kind of jobs. So that's where it gets a little bit slightly seasonal. The order book is there. We'll deliver. So I think the fundamentals are all okay. I don't think there's anything to worry on that.
In fact, also our projects waterproofing, that has grown even faster than retail because we were a late starter in that category. So the waterproofing product sales have done exceptionally well. It's just that the application in some sites has got impacted because of these local restrictions.